Ladies and gentlemen, thank you for clicking on this video. I appreciate each and every one of you. In this video, I'm going to show you a strategy which I use in order to trade the UK 100. Please subscribe to this channel and become a member of this community. I share videos on a weekly basis, and I also have a group where I teach students how to trade Forex and make money from home or from wherever they are, part-time or full-time. And without further ado, let's do this. First things first, what is the UK 100? Let's go to Google. The UK 100 is the index, is a capitalization weighted share index that comprises of 100 companies listed on the London Stock Exchange with the largest full market value. So it's basically 100 most powerful, 100 most lucrative companies in the UK. I live in London, so this is very close to home. So let's go back to TradingView. So we are right now on TradingView, and I've already selected UK 100. I use Orlando. They're a very good broker. So UK 100 and the broker is Orlando. You go to TradingView, you select that, and you will have this on your chart. But right now we are on 4H time frame. 4H time frame. For this strategy, you only need 2 time frames. You only need 4H and 1H, nothing else. Okay, I'm going to show you a super simple strategy, but you need to follow the steps very diligently and watch the whole video to the very end. Let's proceed. So you open your TradingView and you go to settings. In settings, you scroll down and you go down to session breaks. Session breaks are going to divide each day. So now that you're looking at the price action, you are seeing that this vertical lines, they're separating the beginning and the end of each day. Now that's done, what do we look for? Let's just say we are on this day. Okay, we need to look at the previous day, and on the previous day we need to identify supply and demand zones. Okay, so if you don't know how to draw the supply and demand zone, then I suggest that you watch my other video in which I describe on how to identify supply and demand zones in the market. So once you identify your supply zone, which is this blue candle over here, you then wait for the price to reach this supply zone, and that's your entry. So that happened on 4H, and then you drop down to 1H. On 1H, all you're looking for to happen is for there to be a touch of your zone, touch of your 4H zone, and then you're waiting for a 1H engulfing candlestick entry. Once you see that, you place your stop loss just above the wick, and your take profit is going to be towards the next 4H demand zone. So it's from 4H supply zone to 1H demand zone. Your take profit is going to be right here. So that, ladies and gentlemen, is 3%. Now, it's all about making steady profits. It's not about making ridiculously huge profits and then being stopped 100 times and then making one trade that does really well but consistently losing your accounts. It's not about that. It's about steady gains. Steady gains is much better, and it also means that your strategy it has what it takes to withstand the ups and downs of the market that you're trading. So that's that. Let's look at other situations where this strategy can work. So let's just focus on this situation here. So this is how you would have seen the market. It would have been like this. This day hasn't really opened yet. That's the previous day. So this is the current day, and you're looking at the previous day. All you need to see is that, okay, cool, the market is trending downwards. The market is bearish. So the market is bearish, the price is going downwards. That's quite simple. All we're looking forward to happen is the price to retest this zone and then give us a 1H engulfing entry, and then we sell the price from within the area of influence of this supply zone. It's quite simple. It's simple, but it's not easy because it requires you to stay focused and be diligent. So once the price actually reaches your 4H zone, what are we waiting for? We are waiting for a 1H engulfing candlestick entry. Once we get that, we don't enter the market. Now in this example, if you pay attention to this 1H candlestick, this candlestick actually did engulf the area of this bullish candlestick. However, it closed at the same level as this candle. On a 1H time frame, sometimes that is quite sufficient. That's quite sufficient. So what's your take profit going to be? Your take profit is going to be, because we don't have any demand zones that are going to obstruct the price, we just aim for 3%, secure a profit, and then hold the trade for as long as it is necessary. So as you can see, the price dropped down quite drastically from that level. So that was a good one. Okay, so the principle remains the same. You focus on 2 days. Nothing complicated, nothing extreme. It's just very simple. Okay, so we are on this day. We are currently on the 1H time frame. We should be on the 4H time frame. There we go. Now that we're on the 4H time frame, what are we looking for? We are looking for the previous day to have a good supply zone. Okay, so the market is currently ranging sideways. As you can see, it's ranging sideways. There is no particular structure in the market at this very moment. You can see that it's ranging sideways. Sideways means that the price doesn't have any concrete structure. Neither the bulls nor the bears are in control of the market. So it could go anywhere. But nonetheless, if we are on this day, we are waiting for the price to reach this zone. This zone was formed on the previous day. Why previous day? Because whatever happens on the previous day has the strongest influence on what happens in the next day. So previous day supply zones are very strong, they're very potent, and they have high chance of pushing the price down. Not every zone is going to hold, but when they do, it really does work out. So now that we have seen the price reach this zone, we drop down to 1H time frame. And what do we wait for? We wait for a 1H engulfing candlestick confirmation. Right there, ladies and gentlemen, is our 1H engulfing confirmation. We get our tool, we place our entry right here, stop loss right above the swing high, and the take. Once you secure 3%, you secure your trade and you can hold it for as long as you find necessary. Let's just go somewhere super random. We're going very much back in history. Okay, so right over here we have a very good example. We are on this day and this is the previous day. In the previous day, we need to identify a nice demand zone. That's our demand zone. We draw the area of influence of the demand zone from the body to the lower wick into where we are, just like so. Now we drop down to 4H time frame. We wait for the price to reach our demand zone. We wait for the price to reach our demand zone. This is where the touch actually happened. I will mark it out for you like so. There we have it. That's our touch of the zone. And then we wait for there to be a 1H engulfing. That's the 1H full engulfing candlestick pattern. We place our stop loss just below the wick, and then we make profits. Depending on your trading plan, you either aim for 2% or 3% per day on this chart. So that concludes this video. Thank you for watching. Subscribe to this channel, and if you want to learn in detail exactly how to do this, then click the link in the description section below. I am Liquidity. I'll see you in the next one. Take care.